Hey, Paul Morrow again, back on Smart Financial Lifestyles, our podcast. We like to call this Nothing Good. Nothing good happens last minute. Everything takes a little bit of planning. And we're so happy today to have, it's like a repeat performance of David Pine, who you might have seen little clips of from our September 25th Smart Financial Conference. Hey, Dave.
Hey, Bob. How you doing?
Good. How you doing?
Good. Thanks for having me back.
You're kind of a rock star now. Well, you didn't scare anybody away.
Yeah, that's good. That's good. Yeah, I'm a big guy. Sometimes people get scared when they need.
But you did a great job. We had just checking with our assistant Kathy about how many people actually wanted more information about real estate.
Yeah.
So that's one of the things that we're here to talk about. You'll also notice that Pine's got a LA sort of vest on, standing for Lawrence Academy.
Yes.
Right?
Yes.
Go Lawrence Academy.
Go Spartans, yeah.
We have a lot of Lawrence Academy connections in the firm. And so, great of you to come along. I think that we'll try and condense some of the things that we talked about before and then get into some new areas. Right?
Yeah.
So, at our conference, we were talking about wealth and my trilogy of smart financial grandparenting and smart financial longevity and smart financial wealth building. And real estate's a huge part of wealth building and entrepreneurship, but also can be a very effective tool in the other two generations of the longevity planning for lifetime income, or nothing pays income like a well sort of structured piece of real estate, and grandparenting. Nothing is a great wealth transfer better than doing some joint venture property with family and friends and leaving them a lot of great assets. So let's kind of talk about the state of the industry first. I saw a report come in yesterday or the day before about increasing construction costs, adding about 20% to development costs. Can you talk about that a little bit? What's going on?
Yeah, so after COVID, I mean, real estate, the construction costs really kind of took off. There's labor shortages. Obviously, a lot of like the kind of ice raids and stuff have been affecting that. Material costs, like tariffs, it's very sporadic. I don't know if you saw they floated a 50% tariff on like cabinets and everything like that. So then everyone scrambles like, all right, we gotta go either local with cabinets or it's gonna be like more of the bottom line. So it's been a very kind of volatile situation with construction costs. And the rule of thumb is too, construction costs never really come down dramatically. Yeah. Like even if when the market holds, materials are what they are, and the amount of labor is kind of what we have. So yeah, it's been going up and up, which is kind of it's always a good time to buy real estate when you have the long-term mindset, because the costs are always just going to continue to increase.
It's never going to be cheap. We say this all the time, and there's a lot in my books about real estate. I'm a big fan of real estate, and we've owned a bunch of real estate over the years. My son's deeply involved in real estate, and I do think that it's almost trite to say this, but it's like no bad time to get in. You got to act. You got to get in the game.
Right.
And inflation and all that will be your friend. We talked to a lot of parents and grandparents. Should we wait till there's a market drop to help our kids buy real estate? You can wait a long time.
Yeah. I would say one thing people don't even think about too is there's always new building codes that come out, right? The current building codes are giving everything's basically has to be electric now. So even those costs that you cannot, the home that your parents have or the home you have can't be built today for nearly the same cost it was. So there's just so many factors that push it. But like you said, I think housing, in kind of real estate, is always a pledge against inflation, because as inflation goes up, those costs spike. So.
Yeah, as long as women keep having babies, we're going to keep needing real estate.
Yes.
And every year we keep adding more and more babies to the population, and everybody who reaches 22, they get out of school or whatever. What's of their top 3 things they want to do, other than have a big celebration party that there's no more school? They get right to the topic of what Warren Buffett calls family formation. They want to get a good job, find a great wife, buy a house, have babies. And if those things don't happen, the economy does not move forward. Right? The economy moves forward on family formation. You don't sell a lot of countertops for people who aren't building houses, right? And that sort of thing. And you see it rolls right into Home Depot, Lowe's, construction supply equipment, and all that kind of stuff. Yeah. So generally today, it's just come down a little bit. We kind of predicted that, and we went through this spiky deal, and now we're kind of settling back to maybe more normalized rates. does that really, do interest rates dramatically affect your business?
They do in the sense of just like costs. Like every cut kind of helps us. We do like when it's ground up, every kind of half a point that gets cut will kind of give us more kind of flexibility. When it comes to like buying real estate, not too much. I mean, it makes the market a little bit more competitive in some ways. Like if you're buying an existing asset, because more people have kind of access to money. But if you're there and you're kind of like cash rich, it can be almost like hurt you at times because more people can borrow at an easier rate. So in some ways, yes. In some ways, no. It's a complicated answer. I'm happy they're getting cut just because we have things going to start construction in the next like year or two. But it depends on the kind of individual investor. So there's a lot of money sitting on the sidelines waiting for rates to get cut. So if you were like, hey, I want to get in now, your property will be more valuable when the rates do get cut.
Yeah. Tell me about your specific company. Just talk about your company and the depth and breadth of what you guys do.
Yeah, so I work for a developer who we look at everything. We look at kind of ground up, existing. So a lot of kind of early stage developments will buy either raw land or permanent land and then develop that. So it's really great returns.
And that's residential.
Residential and commercial too.
And commercial. Okay.
Yes, we like industrial has been like really great to us, and like we've looked into like kind of those projects, as well as some retail every now and then, as well. And medical office too is what we've done some of, which is slowing a little bit in the past few years. But yeah, medical office is great to us too. So yeah, a lot of different, all the kind of big commercial kind of aspects. So and sometimes we build those, and sometimes we permanent flip. So it's we're pretty versatile.
Yeah. Okay. So as a big development company, clients of ours, get approached all the time by developers that when I go to their house, and it's like, it's the classic story. My brother's selling his house in Sudbury right now, and looking to downsize, had to go back to his wife's roots in Maine, or go to Southern California where the granddaughter is, which is
Tough decision.
mind-blowing decision to sell a house in Sudbury and end up buying a closet for the same amount of money in Southern California.
Yes.
Ventura, California, and a lot of other markets in California are just so bubblicious. It's hard to even wrap your head around it.
Yeah.
But people in California make that lifestyle decision. From the folks that we've talked to over the years and worked with, we have lots of clients on fifth year, all over every state. In California, they make this decision. I don't care about as much square feet, because I know I'm going to get less square feet.
Right.
I love the environment. I mean, if you're a person who's like a Northern California person, you can't talk about it. I mean, they just got to have the Bay Area. They've got to have Marin County. They've got to have. Right. If they're a Southern California person, you can't talk them out of that either. I mean, they want the beach, they want the ocean. My nephew surfs, I think, more than he does anything else.
Right.
And it's a lifestyle. It's not just, everybody else they live near has a tiny home lifestyle. Before the term was even invented. It's like more square foot. And then, geographically, we have some clients that, my son's active in the state of Ohio. He just went through an auction there for a bank, auction thing. I mean, it's remarkable how much of a beautiful home you can get.
Oh, yeah.
In the Midwest.
Yeah.
For literally a third. It's a third of the cost.
Yeah.
And I don't know whether it's a third cost to build or just because the whole economic picture isn't as strong. Incomes are less, job ops are less. But now with technology, I think one of my son's good friends in the bunch is working there remotely.
Oh yeah.
On the internet and.
Yeah, the cool thing about the country is just, America is like, there's so many different options, and they're all kind of changing too. Like the Midwest has performed really well. Like it's to get in a few years ago was a really good time, because like you said, the cost of living has gone up for so many people. It makes the Midwest more attractive. I always think of Florida. A few years ago, Florida was the best ticket, like in real estate. Everyone was moving there, cost of living, like everyone wanted it. Now it's the cost of living's gone up. The demand's gone up, so prices have gone up, and they have a huge insurance problem right now. Like people are getting crushed and people that have just moved there have to flee. So where you flee, where you want a low cost of living, low taxes, it's more of like the Midwest, the Rust Belt. And like you said, I think remote work is something my generation is. There are people now would rather take less money and work remotely because in their mind it has
it's a lifestyle benefit.
Yeah.
I have to tell you, and I've been in a lot of those cities that, like in my career, been in those cities and seen some of their homes. I mean, you can live in the greater St. Paul area, which is very reasonable.
Yeah.
I mean, and they have a big city, and they've got sports teams. And they've got, now, of course, if you're a Red Sox fan, and you're like, you have a problem. I mean, you're going to live in New England, all right? And like, if you're a Patriots fan, I mean, we have some of these folks. I mean, they just suck it up. There's no way. They just do not want to be, move to Milwaukee or be a Green Bay Packer fan.
Yeah.
It doesn't fit in with their goals in life. But tell me, I know you mentioned the insurance issue, and I know, in fact, we have some clients out of Florida that try to sell their houses, and now people can't buy them because they can't get a mortgage, and you can't get a mortgage, and you can't get insurance. So it's a real cash-only buyer.
Yeah.
Which takes your funnel down to a few people.
Yeah.
That can actually buy these multi-million-dollar houses in cash.
Yeah. And there's so many people on that kind of same boat where, then that person, if you're that buyer, you have your pick of the litter. You know what I mean? Like, you don't need to, if you want to, you have to sell your house for 1.4 million, but there's better houses at 1 million that same, kind of category, you're out of luck. You got to come down on pricing. And the kind of Florida condo collapse was horrific, event that happened that time. There are condos, same thing, multi-million-dollar condos that if they were built, in the 1970s, 1980s, it's just tough. People will not want to. Banks do not want to take out a mortgage on those. So it's an interesting time for Florida, but it's one of the reasons I really like kind of New England, because we do not have those kind of, out of all everyone has climate problems and climate kind of threats. We don't have them as bad as I think is kind of California, Florida, Texas even.
So you guys have a big New England footprint.
Yes, yeah. We're primarily, I primarily worked in New England. We always look kind of the Carolinas, as every developer I think right now wants to get in there. So we look all over the place, but yeah, primarily New England. So
yeah, it's funny. My brother downsizing from their home in Sudbury, Mass. Like I said, they tried to make a decision. I mean, in Maine, Portland has arrived. I mean, Portland is a cool place. It used to be a bargain, but a lot of places, the bargains are being sort of eliminated because there's so many people running around with a bag of money on their back looking for a place to land.
Yeah.
That these properties get bidded up, and then that establishes a new price, for the comps. And the next thing you know, every house in the block is $800,000 because there's 3 or 4 people bid a property up to $758, and then that Trump thing really gets them. I've been in the insurance industry, part of our business, for many years. I have to say, I don't get why we don't federalize insurance. I don't understand it.
Yeah.
It's a state-regulated business, which is the craziest thing in the world, because anyone who understands the fundamentals of the insurance industry is that the more you spread the risk, the better deal it is.
Right.
And the more spread risk means more, properties or people insured. And this applies to medical as well as, every other kind of insurance.
Right.
But for some reason, the insurance industry began as a state-regulated industry. The rules in Florida different than the rules in Maine, different than the rules in California. It's like a real hodgepodge, patchwork of rules.
Right.
And what's bad is they don't levelize the rates between some of these high-risk areas, Southern California, Palisades fire, with a place like Minnesota. I never saw a fire ever.
Right.
In the entire experience, but it's a real problem. I know that, this government that we have, our Democratic government, has been very resistant to federalizing certain things, like insurance, medical insurance, properties, but they actually economically should.
Yeah, I think eventually we will get to a point where we'll have to, right? Because the companies, the private companies are going to get there, and I can't make money in California, Southern Cal, and then the government step in and say, obviously, the people need to have insurance options. So, I think eventually, just the way the world works and the way kind of the climate is changing, we will eventually get to that point. Whether it's next year or 8 years or 10 years, I doubt that's going to depend on a lot of things. But.
So let's talk about wealth building. So my books that are split between millennials and X-Geners and boomers, or Nick now calls me the unks. I'm an unk now. Anyway, so millennials really can do a lot worse. In the big scheme of things, the last 40, 50 years, the average national price appreciation on homes is 4.5%, right?
Yeah.
Greater Boston here is like 1.5%. It's like 6%.
Yeah, yeah, yeah.
I mean, you hear this a lot in the financial industry that people use their home as an asset like 3 or 4 different ways during their life. It's a roof over your heads.
Yeah.
It's basically like forced savings. If you're paying down, I mean, you're saving. A lot of people have a hard time saving. And so guess what? If you're paying that mortgage every month, you are building equity.
Yes.
People use their home equity as a piggy bank, and I think it is responsibly done. There are people who are irresponsible about it.
Right.
But on a responsible basis, home equity, you can use a lot of things during your lifetime, whether it's college expenses or leveraging it up to buy a vacation home or whatever. But you can use that equity without having to move, because one of the things about moving to access equity is nothing's free.
Right.
I mean, we've done this analysis a zillion times. Your own home is usually the cheapest place you can live, because if you sell, you pay commissions, you pay moving, unless you really got to get out of that neighborhood.
Yeah, yeah. Unless you're taking a job that's like, exponentially more, if you pay better than the one you currently have. Yeah, no, and everything's a good cost.
And I will tell you, having worked with a lot of folks in the wealth building process, I mean, there's nothing nothing compares to the sort of the rock hard stability of that material asset, because you and I have talked about this. It's very hard to see real estate with a zero.
Right.
I mean, there's some fluctuations in market value, but if you're in a home as a young person, that might be your starter home, and then next thing you know, you decide you're going to have 4 kids, right? All right, so actually, it makes a lot of great economic sense to leverage up that home, get out some equity, keep it, rent it, and go from the 2-bedroom house to the 4-bedroom house to the magnificent home in Milford, Mass, or whatever. And if you leverage them up, they all keep appreciating in value.
Yeah.
And the math is irrefutable. Your rate of return is actually better with leverage than in cash.
Yeah.
And we've done this sort of mind game a million times with folks.
Yeah.
And so I'm a big believer in wise debt management. I actually have a whole thing about it on our YouTube channel. I mean, people get fearful of debt, and they flip the script, I think, in their heads, and they get this idea that the best thing that they can ever leave their kids is a home that's paid for with all the equity locked in there. But actually, some of that equity could have been very wisely deployed during their lifetime.
Yeah.
Whether it's educate your grandchildren, which, by the way, is one of the chapters in my grandparenting book, how smart it is for grandparents to use some equity like that to help launch their children, or help their children buy their first homes, or, of course, they use it for healthcare costs, because I don't know if you've seen the numbers, but I mean, I've seen it in real life here. Very few children want to move into their parents' home.
Right. Yeah.
I mean, it's just that.
Yeah. Most people. Yeah. Most kids don't want to raise their families the way they were raised. They want their own fresh start.
Yeah, they want their own fresh start. So the interesting thing that the assets in the original family home can be deployed in so many different ways.
Yeah.
That's not just financially smart, but you have to flip the script. I mean, we have a lot of presentations that we have. I just spoke at a meeting in Rentham, Massachusetts, where a whole bunch of people came there about, using leverage in their homes to free up the tax on their retirement fund and leave their kids $1 million without a 40% tax mortgage.
Yeah.
Right? And leave them a house with a mortgage on it, which they're going to sell anyway.
Yeah, exactly. Yeah.
Which has got a lot of,
One thing I've seen recently, just like, in the city of Boston, is I've seen a few people, they will buy, buy their first condo or buy their first triple decker in Somerville, and then they will rent that out, and then they'll go buy their next condo, keeping the mortgage on, and then rents are always going to go up. So I've done the math, I'm currently renting. I'm in the similar situation. My landlord's on his 3rd house, and I'm paying off the mortgage then some for him right now too. So, and he just but they're all leveraged, but it's all there's always going to be people that need to rent in Boston like me right now. So there's so many different ways to do it that are not just hey, I want to pay off the house to $0. And I think it's smart, and and more people in my generation are starting to understand that now too.
I think it's a debt management thing. And actually, by the way, I mean, we did a little podcast recently with a woman about she counsels employees and companies and stuff. And and I'm sure that among your friends and family, I mean, a lot of people have their first blush of credit, and they go nuts. And the next thing you know, the credit cards are charged up, and then credit. I mean, that's quite common among the 18 to 25 crowd.
Yeah.
And then everybody has to get religion and clean their act out. I mean, they can't keep charging Celtics tickets. You know?
Yeah, and the first time you get the first credit card, you're like, wow.
Okay. It's like winning the lottery on a small scale. And instead of like blowing the lottery money, you blow your credit rating. And literally, I had somebody spend $12,000 buying Celtics tickets.
Yeah.
And, you know, all of a sudden it hit them that this is not free money. You know?
I could have gone to something else. Yeah.
So real estate is a wealth building tool. Awesome. Tell me a little bit about one of the things that we talked about in the meeting that we had for our affluent consumers. Okay, let's move from the startup people to that discussion about people that are mid-career, maybe they're a successful professional, they've got some extra resources, they've got some, you know, an interest in sort of balancing out their portfolio from just like pure equities and stocks and companies, which is great. And the fellow that spoke at the meeting with us, Will Snade, great guy. I mean, he's in that world of like pre-IPO companies and aggressive stock investing. But, you know, it's probably important for me to say, you know, all investments have risk.
Of course.
There's no such thing as, you know, like in Spider-Man, with great power comes great responsibility, and with great return comes great risk.
Yeah.
And that's what it is. But there is a little bit of ballast involved in a balancing portfolio. And real estate is, I would say, if not risk-free, quite a bit less risky and more reliable, especially in the things that you do. So your business and your development company is the kind of thing that I would describe as very close to one-on-one direct investing with the people that are doing it, as opposed to some of the things that are in my books about adding real estate to your portfolio. Now, if someone has a substantial portfolio, they have stocks, bonds, cash, and then another thing called alts or alternatives. And real estate is an alternative investment. It is something that doesn't play with the S&P 500. It actually works quite different than the S&P 500. That's why we call it ballast, right? To sort of average out your portfolio. And people can do that in a few different ways. You can actually buy a real estate investment fund, or you can buy a REIT, a real estate investment trust. But you were talking in our meeting, got a lot of people's attention on the difference between general partners and limited partners, which you have on a lot of your projects. Can you kind of talk about that?
Yeah, so a developer is more the general partner, right? They're kind of, that's like our day to day, that's what we do kind of for a job. We kind of put in our own money, go out and like, you know, buy a piece of land or buy like a already existing building, lease it up, build it. And oftentimes developers like kind of like us need a limited partner where, you know, we don't, you know, developers like to have multiple projects going on at the same time. That's how that's how we diversify risk, and it's how we, you know, frankly make money too. So, you know, limited partners will bring in their money. They will get a kind of guaranteed return before like the GP or the general partner gets their money. So, you know, it can be from 6% to 8%, 10%, whatever the developer and like the risk profile of that specific project. And so then they're kind of along for the ride. And when the project cash flows, the project performs, they get a chunk of that cash based off how well or how, you know, poorly it does. So, you know, usually the limited partners are more protected because they're the first people to get paid back and the first people to get the money. And then if the project goes really well, then the general partner, you know, took more of the risk and kind of put more of the, you know, blood and sweat into it, gets the kind of better upside. So,
yeah, but actually, and this is the singular most interesting thing about investing in real estate with a GP-LP arrangement, because a lot of folks, you know, have done real estate, and believe me, and I have done it, and a lot of our clients and associates have done, and there's no getting around it. If you do it all yourself, number one, it is not passive. I do not call owning 2 triple-deckers and collecting rent from 6 people, going through the, you know, and like managing the behaviors and lives of 6 people, their ups and downs, and their job losses and their babies. I've been through that. That is not what I would call passive investing. It's very active. You're on the line. Literally, I've been at those doors with moms crying because their husband lost a job and the 2 months behind her. I mean, I've been there.
Yeah.
So doing the GP-LP thing especially for active professionals, and I'm a big fan of this type of investing for our people that are at the peak of their like earning power, whether it's a Dr. Lawyer, Indian Chief, they're making $1 and their best rate of return is focusing on surgery or law cases, not driving to Somerville to collect a rent check from some. I mean,
Yes.
that's not a good use of their time.
Because there are horror stories about that too.
Oh.
That's one term that always gets me, like passive investing. You're like, oh, it's like easy, money will just flow in. I had a buddy, he bought like a triple decker in Southie.
Yeah.
And like he bought it, you know, kind of free and clear. He did the building inspector, like everything passed. And then like, you know, he was living in it and they had a mold problem in the basement. Like, you know what I mean? So all of a sudden, like, they gotta tear it up and they gotta gut the end of the unit. He thought he had like X amount into it. Now he's got X plus another X. Like,
Yeah.
you know what I mean?
Yeah.
All these like half X stuff. So that he didn't do anything wrong. It's just like that's how it goes sometimes. It's bad luck. So like you said, if you're like, oh, I'm gonna, you know, whatever, I'm just gonna go and collect the rent. Like you're gonna have to be in there, like overseeing it. So things like, especially like, you know, older properties, newer properties, like everything kind of can go wrong. When you
Oh yeah, I had three kids who inherited the property in Charlestown, Massachusetts, not Charleston, but Charlestown, and they decided that they wouldn't use a professional developer and that they would turn this old mill building into, you know, fancy lofty apartments. And the three of them decided to do it themselves, and they didn't actually know what a 21E was. You know, you got three kids in different states, and they got, you know, say, hey, you know, they got architects and designers and all that kind of baloney and great visions, and you know, they inherited this piece of property, so they said, hey, you know, we got this thing for free. Why don't we all invest some money and we'll turn it into, we'll make a big profit. Well, in the end, 21E means that some required testing came along, and they were already pretty far down the road on this project, right?
Yeah.
I mean, because by the time you get one of these done, you've already spent a lot of legal dollars, a lot of like architect dollars, a lot of like other planning dollars before you actually stick a shovel in the ground. Right?
Yeah.
But in order to get to that next phase, they come out with a little machine. And when they found that they had a 21E problem, it was from, there was like clocks being made there, and they had oil, and they were just dumping out the back window, and they polluted the soil. They ended up having to just give up the building. They basically
people can't live there.
they couldn't take it. They actually forfeited it to the city of Charleston.
Yeah.
And they just said, well, you know, we're not going to lose another 500, 700,000. Because once they start digging, you don't know what's going to happen. You have to pay for the digging, pay for the burning of the soil, pay for the reclamation, right? And even then, you don't know if humans can actually occupy the building.
That comes back. Happens a lot. Like you know, you do the environmental tests, and like, you know, depending on how.
That's what 21E is, by the way. I meant to tell you. I said it, and I hate using buzzwords, but 21E is an environmental test. Right?
Yes, but people, like you said, like there's a lot of properties, especially in Massachusetts, because it's so old. Like, you know, if a laundromat was on site, like they will, like the state will say, like people cannot live there. People can work there. But you know, what if the property is not zoned for commercial uses or anything you want? It's just like residential. So it's and that's a lot of like what the GPs do is we spend a lot of pre-development dollars. Like there's every year there are projects you think they're going to take off and they're going to be great, and then you get into it, you run into a problem like the 21E, where the architect says you can't do what you want to do, or the towns, you realize the town's like going to fight you on this, and you know you burn anywhere from like $5 to we're at like $60,000 sometimes, depending on like pre-development dollars, but that's okay. You know, when that's your job, you say that the next one will come. But
there is a famous song about this, and it's knowing when to fold. And you really just need to know. And you know, I've had that experience myself, and I think again I'm sort of tangentially involved with my son's ongoings in the state of Ohio, and sometimes you just need to walk away. I mean, zoning regulations plus things change. I do find, and we'll only go for a few more minutes, and then we'll wrap up. But I do find that real estate's a great wealth building tool.
Yes.
And it's also a great wealth transfer tool. And we talked about a little bit of this in the meeting, that sometimes the regulations go in your favor. And right now, the regulations for multi-generational housing and ADU have really gone, finally, in this state, on a very favorable basis.
Yeah.
And I can't tell you, I have one builder developer. I mean, he's just building so many in the suburbs because this concept of the kids and the parents or the grandparents pooling their assets instead of having like 3 little houses, you kind of picture it on a simple basis, having one great house with some different living arrangements. I mean, we've done a couple different projects, one in Virginia, one in Franklin, Mass, and all just turned out to be so great for all the big 3 reasons. Yeah, and we got at that time through enormous, like schooling to peanut butter regulations. But now, in the state of Massachusetts, if it's 900 square feet,
Yeah.
you can build an additional dwelling unit on your property attached to your house or whatever.
Yeah.
And
Housing is probably the right now in the current market, and I would say, from what I can see in the future, it's the safest bet because as a country, we need so many more houses to keep up with demand. It's something that the state and now and nationally they're trying to give more money. They're trying to relax certain rules. I know there's some stuff right now in front of the governor's desk. They're trying to peel back some of the kind of red tape with environmental kind of regulations. So housing it's a great for building wealth, like you said. It's also the safest bet at this moment. And one stat I always just love, and I said it in the presentation, is we built half the homes in the 10 years after 2008 than we did the years before. That's a crazy kind of slowdown in housing production because the population trends didn't really slow down not nearly as much. So
right.
we really need to kind of build more. In New England too, it's in Massachusetts we don't have as much land as some other parts in the country. So that's why the ADU stuff is being passed, right? Because it's
But you need both. You need
Yeah.
low cost rental housing,
yeah.
and you need places for some of these seniors to go.
Yeah.
And it solves 3 huge differences. And in most cases, if blood relatives are moving in, you get no heat at all. And once the blood relatives pass away, you can rent it to a third party. A young kid getting out of college, starting off, rent your ADU above your garage for a couple of years,
Yeah.
build up some savings. I mean, it's a sort of an entry level residence thing.
Yeah.
Right? And so we need housing options. Also, frankly, in a lot of places that I interact with, I have some property in Colorado, we live there, and there's some very nice places in Colorado, and some very expensive places. And where do the service details of Aspen and Vea, they have to drive 2 hours to get away from the high price real estate. And actually in the town of Aspen, they built a tiny home village.
Yeah.
And near our home in Colorado, they built a tiny home village.
Yeah.
And these are designed to plug that in, but it's a great move by the developers.
Yeah.
Because, as you said, these values keep going up, and instead of them building, 10 $1 million homes, they built 100
small
tiny homes.
Yeah.
They're all rented out.
Yeah.
And as long as we keep making young people that need the expensive places to live,
Yeah.
right, as they graduate from school and stuff, I mean, it will help satisfy that without having to do all the things that are involved in, low income housing and 40B. It gets very murky.
Yeah.
When a developer wants to put in 1,000 units, and they say, well, you can build it here, but you have to have 100 low income. But, low income doesn't save them the building expense of building those same units that are being built
Right.
at $400 a square foot or whatever. it is,
Yeah,
right?
yeah.
So I don't see 40B as a big permanent solution for that.
Right.
It's a patch. It's kind
Look,
of a patch.
I think I always think of we need the missing middle kind of is a big
Yeah,
term
missing
thrown
middle,
around
good
right now.
term.
It's we need the kind of there's got to be a balance between the $1 million houses in Wellesley and then the apartments that developers are
Yep.
trying to put in. You need the starter home townhomes that someone.
Campanelli ranches.
Yes, yeah. And also, I say this that could also mean that could be for seniors, right? There's a big
Yeah.
there's a big push for 55 plus housing, and some people go, oh well, we need more housing for people those people usually are downsizing from a 3-bedroom house in the suburbs that someone's going to move into. So, the missing middle for the kind of young people and seniors, any housing right now is good housing is my thought. Just because we are so kind of behind. So that's at least that's I think that's kind of what you're saying is the missing middle is what often we try to talk about.
And it does satisfy all the 3. So to kind of summarize a little bit, I think, again, real estate is a very complex, I mean, we're talking about it in generalities, but it's a super big, complex topic.
Yes.
And everything from institutional real estate down to these little tiny homes, or everything from $1 million houses to little ranches, you know. And I do think that in the 3 phases of people's lives, there are real estate transactions that fit. Whether you're a young wealth builder who's leveraging up and buying a few places, whether you're an affluent person looking to add an alternative, you want to just give a developer a check for $500,000 or $1 million and say, give me my 1% of this development, when it's done. Very popular, in my opinion. Very efficient, because if your time is valuable, I think it's a lot more rate of return to focus on your own profession and to give somebody else a big fat check. This is the guy, by the way, for a big fat check. I'm going to tell you how to get a hold of it. Look, if you delegate to a GP who's done this every day, all the time, they also know when to walk away from a messy deal.
Yeah, and usually if you're talking to a developer, they're not pitching you something where you're burning the pre-development dollars. Usually we do that on our end, and then we say, okay, this has a chance, and this is how we the path to profitability. Do you want to come along for this ride? Usually you get stuff like the 21E. You figure that out before you even get to someone asking, for money. So.
I mean, I would be a hypocrite if I didn't say that in all 3 of the books that I've written and other things that we've published in our business, I mean, I'm a very big believer in hiring professionals. I mean, there are DIY things you can do. And I know, I go to Home Depot and I get a part and I fix my lawnmower and I enjoy that. And there's certain do-it-yourself things that are safe or low risk or whatever that are acceptable. However, I would say in the real estate area, just like in financial management, long-term care planning, and the other things that we do, it really is very efficient. The money that you actually pay to professionals makes you money. I mean, it protects you. It's like insurance on your dollars, professionals. So, in sort of keeping with all that kind of discussion, and we'll, I'm sure, have more talks about real estate and ways to invest in real estate and how it fits, especially for people who go through these 3 phases of life. You can subscribe to our channel. Just click on a little link that the editors are floating around us there. Hit the button, subscribe to the channel, follow our podcast, and stay up to date with us. Now, anytime you want to contact a person like Dave, who is here in Milford, Mass.
Yep, Milford, Mass. Yep.
Milford, Mass. And easy to get a hold of. And you can contact us through Smart Financial. We'll put you in touch with any of the professionals that we have on our podcast or our YouTubes, and we can help you maybe find the right professional person that can help you put together either a home purchase or a part of your affluent client portfolio or a multi-generational deal for you and your children. So I want to thank Dave for showing up today and coming over here to our Westboro, Mass. office.
Thank you. Anytime. Love being here. So.
All right. And you can follow us again on Smart Financial. I'll see you next time for more of Nothing Good Happens Short Term.